In our multi-asset franchise, our investment philosophy is driven by two core principles. The foundation for all our investment decision making is firstly based on the intrinsic value of an asset relative to what the market prices that asset at. And as an overlay, we use the business cycle to assist us with gaining conviction in the various positioning of our clients' portfolios. So if we start with the business cycle and go back to coming out of the financial crisis in 2009, central banks were trying to stimulate growth and inflation to try eat into the debt levels that we came out of the crisis with. So firstly, they reduced interest rates to all-time low levels and in many developed markets to 0% to try and stimulate growth. And when that never worked, they embarked on a quantitative easing program, which is essentially money printing to try and stimulate growth via the banking system and eventually inflation. With hindsight of a few years, we can see that there's clearly been different outcomes in various countries. In the developed world, in the US, it's been partly successful. They've started to achieve growth rates above 2% again. But in Japan and Europe, they've had to continue with QE until their levels of growth, which are still extremely low at the moment, well below 2%, and inflation, which is also low, and they're trying to clearly stimulate those back to higher levels. In emerging markets, you've got China having gone back into QE, given that their growth started to slow off the very high levels they saw pre the financial crisis. So one of the major unintended consequences of doing all this QE around the world and reducing rates to such low levels is there's been a massive search for yield by global investors. And the reason for that is simply that bond yields have gone to such low levels globally and cash is earning you almost 0% that they've been forced to go higher up the risk spectrum into places like emerging market bonds and equities to try and generate returns that beat inflation in their own countries. And what that's meant for places like emerging markets and many other risk assets across the globe is that it's pushed prices to levels that we don't think are sustainable over the medium-term time horizon. And a great example of that is the local equity market, which has seen a re-rating coming out of the crisis from an 8 PE all the way up to close to an 18 times PE multiple at the moment, which is way above our 12 times long-term average PE multiple on the JSE. So as asset managers, we keep getting asked the question, when will this excess liquidity party end? And we think potentially that started last year when the US finally stopped QE. They believe that it stimulated the economy enough with money printing, that it was sustainable on its own, and that inflation would eventually come back. And they started to discuss when they would finally start to raise rates again. And bearing in mind the US hasn't raised rates for almost 9 years now. So the reason why it's so critical, despite the time period that rates have been so low, is simply that the two key drivers of the bull market in risk assets since the financial crisis have been this excess liquidity in QE, as well as ultra low interest rates that determine the valuation of most assets, and these two factors could start reversing quite soon. So the risk clearly from this point is that those two key drivers start reversing in the not too distant future. Therefore, given the level of valuation that we've got to and the potential for this excess liquidity to be removed, we think it's much more important now to consider risk than it has been for many years. The risk of both drawdown and volatility that we think is going to be much higher going forward than it has been in recent years. So now we think it's all about protecting our clients' wealth that we've managed to generate over the past 6.5 years since the crisis. And there's no point in chasing these last few bits of return in bull markets that are potentially have gone on too long. So what does that mean from our positioning perspective? In the SA market, it means we underweight equities, bonds and listed property, which we think are all expensive on a long-term time horizon. We are overweight, on the other hand, unlisted property, which in the Liberty portfolios gives us a great asset class that's much lower risk than many other asset classes and generates returns that beat inflation quite comfortably over the long term. We are also overweight cash domestically, which allows us to generate a return close to inflation and to remain on the sideline until other asset classes domestically become a lot cheaper. From an offshore perspective, we remain overweight offshore equities, which we think are much more reasonably priced relative to South African equities. And we think offshore equities also offer better return prospects than offshore bonds and cash, which generate close to 0% returns at the moment. So in conclusion, we position our portfolios much more cautiously than we have for many years, as I say, to protect drawdown risk and volatility, which we think is going to be a lot higher in the next few years than it has been for the last few years coming out of the crisis.